we are going to cover Chapter 13, which is Financial Reporting and Analysis for a Corporation. This is a huge chapter where we officially start to really look at a high level at what's happened in a corporation financially and whether things are going well or not, and then what to do about them. So we're going to start with Section 13-1, which is Measuring and Analyzing Financial Strength. And this section has 4 objectives, and they're pretty huge objectives. We'll talk about who users are, what the objectives are of analysis after we define what analysis is, and then we'll look at some ratios related to financial strength. This is likely going to take a couple videos since I'm limited to 15 minutes on a video. But if I were you, as I was going through this, I would make sure that I probably had the PowerPoint slides I'm going through as well as the Blackline Masters so that I could take some notes on that. And then if you want to have your textbook, it's probably not a bad idea. So with that said, let's just move into the very first objective here, talking about financial statement analysis. So that first bullet point there says financial statements contain all information necessary to understand a business's financial condition. So the first thing I want to do is I want you to maybe note, what does financial condition mean? And we've talked about this before, but it is truly just a snapshot in time. And based on the fact that we say we're going to analyze things, there's a few important things as it relates to analyzing. When you analyze, you need to calculate some relationship between 2 different numbers on a financial statement. So I'll calculate that relationship. Then based on that calculation, I want to determine whether or not it meets some sort of standard or target, whether it's good or bad compared to this target. And then based on that, what should I do about it to help in the future and to improve things or fix things? So I calculate it, I compare it to a target, and then I say what I'm going to do about it. That's going to be important when we're analyzing. But back then to this first comment, financial statements contain all the necessary information. That business entity concept that I would want to know about, or concept, not entity, is known as full disclosure. So I have to tell everything that's needed for someone that's using these financial statements to understand them. The SEC is the one that determines standards and rules so that financial statements are prepared from company to company in a similar manner so that they can be compared. And also I would want to know that the SEC requires public companies to submit reports, financial statements, quarterly and annually. So that covers that first bullet. These next 4 bullets really are talking about users of financial statements, and they can be people inside the business like managers and owners, or they can be people external to the business such as banks, lending agencies, or other potential owners that haven't become owners yet. And managers are going to use these financial statements to improve profitability of the corporation, running it day to day and figuring things out. Banks and lending agencies use it to determine whether or not they want to even let our company borrow money from them and whether we have assets for collateral and things like that. And owners and future owners want to use the information to determine whether or not they want to buy more stock or sell the stock they have, keep their investment, what are they going to do, will they get dividends, will they not, that kind of information. So that's what they're doing when they're analyzing. So the second learning objective in this section is about what the objectives of financial reporting are. And as you can see, again, from this slide, the common objectives for analyzing the information are to determine whether we have financial strength, profitability, efficiency, and market value. So in Section 1, we'll talk about financial strength ratios. In Section 2, we'll talk about profitability. And in Section 3 of this chapter, we'll talk about efficiency and market value. Financial statements that provide information for multiple fiscal periods are known as comparative financial statements. And if you look at your Blackline Masters, you're going to have one of the Blackline Masters that is comparative financial statements. And in comparative financial statements, it's going to become obvious that we're putting multiple years of information. But this last bullet point is kind of the key on this slide. To be useful, financial statements must be prepared by using the same accounting principles in each period, meaning in year 1, year 2, year 3, if I choose to use straight line depreciation to depreciate my assets, I have to stick with that the whole time for comparative purposes. So let's go through the Blackline Master on income statements that you have there. So if you're looking at this income statement, notice on the heading for starters, and this is on page 369 in your book if you'd rather use that. So in the heading we have who, what, when, and the when is for the years ended, and there's 3 years presented when you have an income statement. And it's in an abbreviated format, meaning it doesn't give you the excruciating detail on all of the cost of merchandise sold accounts, all of the SG&A accounts, depreciation, amortization, etc. So it's grouping things and giving you an abbreviated form. And we are going to be able to use some of this information to compare and find trends and relationships between items. Make sure that you know on an income statement what is on an income statement and the presentation. So the big components are these over here on the left-hand side. So net sales, cost of merchandise sold, and then operating expenses, and then other revenue and expenses. Then we get to net income before federal income tax. So net income before tax, and then we do less federal income tax to get to net income. And again, corporations are the only ones that tend to put the federal income tax expense down here at the bottom. The next financial statement we have is the statement of stockholders' equity, and it is on page 370 in your textbook, and you have a Blackline Master. Heading again, who, what, when, and the when is again 3 years of information, so for the years ended December 31st. And I would, if I were you, put a asterisk next to common stock, preferred stock, and retained earnings, and then out to the side I would write that for these 3 items, it shows the beginning balance, any changes that happened during the period, and then the ending balance. Beginning balance, change, ending balance. Beginning balance, changes, ending balance. So that's the first thing that I would note about this. The next thing that I would note is that treasury stock, so maybe put a check mark and out to the side, define what that check mark means. Treasury stock is deducted, and you can tell it's deducted because it's in parentheses here, indicating a minus. So it's deducted from total paid-in capital and retained earnings because, as you recall, treasury stock is held by the corporation and it is not outstanding. We don't consider it an outstanding share in the shareholders' hands because we're the ones holding it. And then the other thing that I would want to show you is just the format again, what's on this. So paid-in capital, which includes common stock, preferred stock, and APIC. And then it has retained earnings, treasury stock to get to equity. So we take that total paid-in capital of $299,500 plus the total retained earnings of $223,823.85 minus treasury stock of $22,000 to get to our total stockholders' equity. And then we have our number of shares related to common stock, preferred stock, and treasury stock for each year. Next, we have our balance sheet and things that I would note about the balance sheet, which is on page 371. In the heading, we have just December 31st of X3 and X2, so we only present 2 years of a balance sheet. And you guys already know that we're making sure that our assets equals our liabilities and stockholders' equity. That is key. And then we're breaking this out between current and long-term assets, long-term being called plant assets, and then between current liabilities and long-term liabilities. And then equity, we have those 3 things that we just computed on the statement of equity. So the first thing that I would want to show you is this cash equivalents. So what are cash equivalents? They are short-term liquid investments. They mature in less than 3 years. So I would make sure to note that, mature in less than 3 years. Then we have accounts receivable net. What that means is it's reported at net realizable value, which is the accounts receivable gross balance minus the allowance for uncollectible accounts. The next one is total plant assets net. And what that means is it's the book value of the plant assets. So, for instance, equipment minus accumulated depreciation for the equipment. Then we have down here bonds payable net. And what that is taking the bonds payable plus premium account, deduct discounts to get to the net. And again, down in the equity, paid in capital is your common stock, preferred stock, and APIC. And then we deduct the treasury stock. And that agrees to the statement of stockholders' equity. The final financial statement is the statement of cash flows. This we will learn how to prepare in Chapter 14, but I want you to get a few notes down on this to start on your Blackline Master. So starting with the heading, it is still for the years ended. It also does 2 years like the balance sheet, but it does for the years ended like the statement of equity and income statement. And the things that are on it, I would just write out to the side OIF, O-I-F. So operating activities, all the way here, investing activities, and financing activities. And the operating activities, and I just write this out to the side, are the changes related to current assets, current liabilities, revenue, and expense. So all the cash in and out related to current assets, current liabilities, revenue, and expense. For investing, it's the cash in and out related to long-term assets. And then for financing, it is the cash in and out related to long-term liabilities and stockholders' equity. So I am trying on this bottom part to explain the change in cash from January 1st to December 31st. It changed this much, and that was attributed to cash that came in and out from the operating activities, the investing activities, and the financing activities. So that covers the first 2 objectives of Lesson 13.1. I will do another video here that's going to talk to us about the first set of ratios that we're doing, which are financial strength ratios.